So my overarching premise is that things that have never happened before are mispriced, or the most mispriced things in markets. So the world's dynamic, it's constantly changing. Obviously prices do too, but when things are different, markets tend to lag. And the lag, and then generally they'll go through an overestimating to underestimating period. So a good example is China. So China was irrelevant in the world. And I started Passport in 2000. I did emerging markets, 96, 97, 98. So China should have been on my radar screen, but it was irrelevant. And we were doing energy, shipping and mining and making bottom-up investments in companies. And China was not really mentioned by anybody in the companies that we were investing in. And then in the middle of 2003, China became learned by markets, or at least as a hypothesis, to describe why copper and oil were rising despite not very good growth in the OECD countries. And so there you had China had been growing quite a bit, and China entered WTO in 2001, but it was not a market event. It never happened before. Didn't know what it really meant. But as companies, the way I look at it, as companies after 01 was the time that our economy got really weak, Greenspan started cutting rates. I think companies started, after having overspent on CapEx for tech, telecom in the 90s, they decided to keep their margins as high as they could. They moved labor to China throughout the 2000s, which obviously stimulated building manufacturing capacity and commodity growth. But it never happened before. So it wasn't understood until we saw it through the lens of commodity price, which is strictly a supply-demand equation. And that for the next 5 years was this rise in commodity prices, rise in emerging market stocks, and a rise of China. All along the way, there was skepticism because it didn't happen before. But of course, oil broke 40 in May of 2004 and then was $100 higher. And that was beyond anyone's imagination. So the point is, governments are bad allocators of capital, but markets are generally overrated in figuring out change, but they're the best things we've got. So when you get a big change, a big macro change, it can take many years, I think, for markets to catch up because it's not anybody's models and there's nothing in the past to refer to. China is changing so much that people have a hard time understanding it. There's a lot of negative, just very negative people in China. And then again, China has, every year for China, it's never happened before. People seem to want it to be a, over misallocated capital EM story because of all the building they've done. And they can't see how they're going to go from here to a consumer-oriented society. But every other country did the same thing. They spent a lot of money, U.S. included, and they're going to do it in a different way. And so I try to take advantage of these things that I think are highly likely to occur, particularly when it's different than it was before. Good example that we're involved in is Chinese internet companies, where I think there's a leapfrogging effect in China because they didn't have decades and decades to build retailing and a lot of service businesses. I taught English there in 1988, the first private university, and my best students wanted to be farmers because that was the only part of the economy that had market prices. So that was the only way they could make money. So anyway, it's these things that are big shifts that take a long time for markets to understand and digest. And that's why I think macro matters so much. If you don't try to understand that, then eventually those big shifts will change prices maybe for the good, maybe for the better, but you probably want to understand them. So I tried to understand.